So I'm going to be speaking from a unique perspective. Last year at this time I was an investee. I was out looking for money and closing an acquisition deal with Hologic, who purchased our company in August of last year. And now I'm an investor. I'm out using the funds from that acquisition, and I'm involved in quite a few medical device companies. So I'm going to talk about both sides of the fence today. Next slide, please. Oops. Let's see if I can do it myself. Here we go. There we go. So from 2004, that's when we founded Sentinel Medical. We took advantage of working off of my master's work that I had done in breast MRI. So at that time, it was a high potential modality, and now today, actually, it's just been announced by the Ontario government. It's going to be one of the biggest screening programs for high-risk patients in the world. So it's evolved tremendously over those 7 years, and likewise, our company grew very quickly. Now from 2011 onward, I'm an active investor in the space, and partly because I see opportunity, I know the space, but also these companies really desperately need funding at this point. So my experience as an investee, it was a classic bootstrap for the first year. In fact, our first year spend was $250,000, and that was with about 5 people in the company. So it was really off sweat equity of the founders, and it was myself and 3 others. The total investment that we raised over the course of the company was $18 million. The first 2004 to 2005 was directly from friends, family, and the founders' funds. Next was interested customers. So as we went out and actually started selling the product, we had customers coming to us to see if they could actually be investors in the company. So that was really off the strength of the product that they saw the potential opportunity. Beyond that, we got into some other private investor groups, 2007, 2010, where the bulk of the money was raised. And I'll break that down for you in a little more detail. So our company from 2004 to 10, we hit revenues of $18 million in our final year. And as we grew, it was well over 2 times revenue growth over year to year. This year, we'll be coming in at about $30 million in revenue, and we're about 230 employees at this point. Real challenge with growth on that level, and that was our target. That came right out of our business plan, was doubling our revenue every year. The challenge is you need to fund your inventory, and in our case, we built hardware. We built physical systems that were quite expensive. So you anticipate you'd get some kind of support from banks or the like to help fund those inventories. And the payment terms, when we started with the company in 2004, we modeled about 30 days with hospitals. And after the financial issues in the U.S., that shifted to about 90 days. So a huge outlay of money that we needed to bridge. So actually that growth can really be a problem for you as you are successful. Banks were really not beneficial. And again, I'm going to personalize some of this, but I'll try and generalize it a bit later. We only got about $500,000 operating line at the end, and that's when we were doing $18 million and finally started showing some profits. Shred, our SRED was really a lifeline for us. Final year, we had about $1.5 million in Shred, and if it wasn't for the Shred, we wouldn't have been able to invest in new product, and that's critical. I think the days of having a one-trick pony medical device company are gone. People are not going to invest in you for one product. They want to see a line of products and a future. We had excellent support from the Ontario programs, not as much from the federal programs. In fact, we put a lot of energy into IRAP, and we received some funding, but it was really much smaller than we received from HTX, OCE, and then recently in our final year, MITAX. I'll just dig into the investor return. So this was really interesting as we went through the acquisition. We sold to Hologic for an upfront payment of $85 million, plus an earnout. And the earnout is actually larger than the upfront acquisition amount. Of course, it's still in progress, so it's anticipated. But it's really critical to align our investors as we went through. So the first investors who joined understood high risk, but also a longer time horizon. The last investors who came in the 5th year really understood potential acquisition, and also the risk was much lower, and therefore the return would be much lower as well. And what I listed there is a breakdown from, I looked at our investment groups over the years and averaged over the group that came in the 1st year, 2nd year, 3rd year, up to 5th year. The group that came in the 1st year got a 40 times return, and non-compounded annualized return was 800%. So very successful, but a lot of risk. You know, it gets discounted at the end. Whereas second year, 330, or 13 times. Third year, 167. Fourth year, 3.3. And now these are getting into years where we're really using the funding to support inventory build and growth. And in the final year, it was really supporting through the acquisition, which is about an 8-month discussion with Hologic. So even with that investment group, of course, very early investors were very happy, but even the later investors with the 2.5 times, they're moderately happy. So the happiness of your investors is really critical, and you realize that when you go right up until whatever the event is, if there is an event, but a decision to be acquired, you go out and you get voting from your shareholder base on whether this would be an appropriate deal. We were fortunate. It was a great deal, 100% voting. But when you start dissecting some of these other deals, you run into some really big problems where investors have been overpromised and you've underdelivered, and you need to convince them at the end of the deal that it's an appropriate exit for them. Now I'm just going to step back a little bit and talk about environmental conditions. Some of this was mentioned today, but I think in the context of an investor, these are very important. When we started the company, largest market by far was the US, and it was also a 64-cent Canadian dollar to US dollar, and it's completely reversed. So flexibility in the business plan is really essential. We're looking in my area, in the MR world, outside US is now accounting for about 50% of the market, and that was about 15%, so it's a massive shift within 5 years. Regulatory hurdles are increasing in Canada, and particularly in the US. Our first product took about 6 months to take through FDA 510K Class 2 approval. However, our latest product has been over 1.5 years. And that's a fundamental issue for private equity and venture capital, where you just don't know when you can start producing. So if you have a choice between investing in a mine that you can be pretty certain about when you're going to be pulling silver out of that mine, or a medical device product that you have no visibility to when you can actually produce and deliver and get revenue, it's a huge risk issue. And private equity and venture have been really decimated. For one, their accounts are very low, but for two, they're just not willing to take on that risk as you move forward. Big issue, as you see it on the news every night, is banks really are not providing loans. There's liquidity being pumped out there, and the banks are just storing it, and we're just not sure where it is, actually. I think it's going to come through one day, and we're going to find out where all this liquidity is. One area we know it is private investors. Private investors have quite a bit of capital on the side. They've been spooked out of the stock market. They're not sure where to put it, so I'll go into a little more detail on that in a moment. The other issue is governments. Governments have typically stepped in and supported more funding for these small companies, but we're going to be entering a time where there's austerity programs across governments around the world. So if the governments are holding up private equity and banks, there's a real funding issue. Point that was made earlier, technology really is evolving at an exponential pace. I think it's very positive. Huge change, upsetting the current standard of how care is delivered, so huge potential for new products to come in and offer phenomenal value propositions. So we're seeing these problems coming up really exponentially. We're seeing demographics changing, an aging population, but also the opportunities in tow are also exponentially increasing. So in short, opportunities really abound, but there's no funding, and it's absolutely critical. This is a chart on the bottom years, and on the left is a percentage of GDP of spending for the U.S. government. This was from June 2009, so 2 years ago. And you'll see that spike, and you'll see 3 layers. And if it's not coming through clear, the very top one is Medicare and Medicaid's expenditure, Social Security, and then other programs below. That spike's associated with the economic collapse that occurred. But what's happened since, and I think a really interesting data point, is from then till now, there's been a total dislocation of the projections versus the actual spends. So it's actually approaching 40% of GDP expenditures. So they obviously missed the boat. So that's pretty scary. It's frightening. But you also see opportunity in the graph. You have an aging population where more and more spending is going to be driven into healthcare. That's really a double-edged sword. You see some people saying, well, we obviously have to cut that expenditure or else the U.S. will go bankrupt. But on the other end, people are saying, in an advanced civilization or economy, would you not want to be spending your money on healthcare? Is that not the appropriate expenditure? So very interesting, real problems there. And if you look at the red bar on the far right, over a third of interest, and that's not showing interest on that graph. So when you move out about 40 years, a third of the expenditures are going to be allocated to interest payments on the debt. So this is something to keep you up at night. Something I pulled out of this was actually just last month in the Medical Device Daily. It's a nice little daily report on what's happening in the medical device industry. But this is looking at deal size for medical device companies and merger and acquisitions versus year. So you can see on the top row, that's the upfront payment, all-in upfront payment from 2005 2010. So you've seen some growth, and what's happening, you can read out of that, is companies are buying for buying larger companies, and they're paying more for those companies. So you're tending to see that in mergers and acquisitions, waiting until products and companies are more evolved to make those acquisitions. There's also becoming more acquisitions that's starting to increase, and that's been a function of companies cutting back their R&D and needing new products to enter their pipeline. So you are seeing an increase in merger and activity in the field. The other line, middle line, is the average deal size plus milestone payments. And we had a very unusual situation where most of ours was allocated in earn-out components, but that's starting to be the trend. And that really changes the dynamic of an acquisition, but certainly that changes the dynamic of the investors that are involved. There was a recent acquisition where the earn-out period was 5 years. So the upfront payment was about a fifth of the anticipated overall, and the rest of it was pushed into the future. So you're also seeing companies taking risk out of the acquisition by deferring into milestone, into earn-out payments. So there's increasing need, but this is an interesting aspect. And certainly when you do an acquisition and you ask your investors to sign on to it, it creates a really interesting dynamic when you don't know what the actual valuation of the company will be. This is information I pulled just from the recent Profit 200 magazine that was just out 2 weeks ago. That was really interesting. This is looking, on the bottom is sources of capital. And on the left is the percentage of these companies, so it's a poll of the 200 companies, and these are the fastest growing companies in Canada as measured by revenues over the last 5 years. And it's whether they've accessed those different capital pools. And you'll see founder-owned capital, number one, 72%. Canadian banks, 67%. Shred, right up there, number 3. Credit cards, expensive way to access capital. BDC is on there, but lower than credit cards, which is unfortunate. IREP dropping off as well. Other government, so some of the Ontario programs. And you start moving down, venture capital's down there, 6%. So we spent a lot of time talking about venture capital, but I'm going to challenge whether that's relevant. Are they relevant at all? This is whether they've accessed the funding. It's not how much funding they access through those areas. So that wasn't available. I couldn't pull that apart, but I could pull it apart in our history. So this was from Sentinel Medical. Over our last 3 years, where did we access our capital? So founders own capital. That would have been higher if we weren't all poor students. It would probably be a bigger bar. Canadian banks were disappointing to us. Very little support, as I mentioned. Shred was really a go-to for us. Leasing, we only started enacting at the end. Credit cards, maxed all the way through. Friends and family, maxed all the way through. BDC we didn't have luck with, and I think that's something we need to examine. I think that should be a great source of capital, but I know there's been a lot of medical device companies who have not been able to tap into that. Private investors, non-angels, was really the majority. We brought in money off the sidelines, that really their choice was going into equities or potentially going for a riskier opportunity like ours. IRAP put a lot of energy into that, but really didn't get a lot of funding out of that. Ontario government was a smaller bar. Suppliers, unwillingly, I think the suppliers helped support our company. Asset-based lending was one of the angels who had a lot of capital and was able to come through and lend against our assets for about a 3% rate, so that was really beneficial. In professional, I really grew professional and private investors. I mean, they've got to be accredited, so in some way they're all professional in one extent. So that was really our snapshot. More importantly, when I talk to companies who really came to our level or are in the process of, it's also very similar. You're not seeing many companies with venture capital funding. It's really dried up. but in a lot of ways that provides for new types of capital. And you actually see on there no private banking either. So just moving through the transition of being the investor to the investee to the investor. Recently, I've been able to invest, and I'm comfortable investing in the space that I understand well. And that's not just myself, it's the entire group of founders. In fact, we've been investing as a group. The companies we've invested in range from $2 million up to $150 million valuations, all the way from zero revenue to just accelerating revenues, $25 million. And I kind of distilled back from myself, but also talking to the group, what do we look for? What do we feel comfortable? It's a significant group. If you look into the group of private investors that we brought in and the new group of investors who benefited from the Hologic acquisition, it's about $150 million worth of capital that this group is able to shift around. But very similar things of what they're looking for, but also similar things that we see in successful companies. One is, from an investor's perspective, is a diversification against other investments. You know, we're seeing really wild fluctuations in the stock market. It's nice to diversify by something that's not directly impacted. Two is looking for a really well-challenged business plan. If you don't have a business plan, you really don't have much of a business. But incorporated flexibility into that is really critical. There's a lot of, I'm not sure if anyone's read the Black Swan book, but it's really an interesting perspective of how well you can establish an organization or entity or yourself to take on the unplanned and the adverse events. The other is return concordant with risk. It's really critical that you can actually value the proper risk level of where the company is relative to earnings. Yeah, there is multiple generations of product. I mentioned that previous. It's really critical that it's not a one-trick pony. I think those days are over. Tied in with world leaders in R&D is a very important point. There's many more R&D laboratories around the world. There's thousands that have been upstarted in China. And without being a world leader in your area of expertise, you don't know what's going on in those other laboratories. And if you don't have visibility to what new technologies are coming out, you're really going in blind. So it's really critical that it's a world-leading group that you're part of. Buy-in from luminaries. Buy-in, what I mean, luminary customers are the customers everyone looks to. They're the leaders of the industry. If you have their buy-in, then that really gives some pertinence to the product. A talented, balanced team is important. Not too many techies, not too many business people. That's really important. Lean operations. There's too many companies going out and acting like they're Fortune 500 from the first day. That tends not to bode well. Point that I tend to look for is inevitable products. A product that you can look to and not imagine it not being there. You know, thinking about this product and saying, well, it's got to happen. It's just a matter of time. I think it's a really critical aspect of a product. And the last one that really clearly I see across companies that are successful, you have a lead that's not going to leave. They're tied to the mast, and there's Ulysses tied to the mast. They're not going to leave when the going gets tough, because inevitably there's going to be very tough times. It's going to be very easy to walk away. You need the confidence that that person's not going to leave the company. So in concluding remarks, there's really never been so many wonderful opportunities in healthcare. Large companies need new products in a changing space, and they really need to acquire to innovate. There hasn't been that long-lasting funding that's gone into their R&D programs. Funding is really difficult to obtain from banks. It has been in the past, and it's worse now. So you just can't rely on that. Funding is typically coming from sources now that you wouldn't expect. I hope my graphs helped illustrate that a little bit. Personal experience, although I showed you examples of my personal experience, I can tell you it does line up very well with other companies that I've seen become successful over the past 3 to 4 years. And you do tend to see companies with similar traits, as I mentioned on the last slide. So I hope that was helpful, and thank you for your time.